As the always dour Dr. Doom is out with his latest report. I don't know if he's always dour. While the picture is not rosy, he does believe the dollar will rally and equities will considerably outperform bonds. Joining us now is Marc Faber, editor and publisher of the Gloom, Boom, and Doom report, and here to comment on what Mr. Faber sees, David Bianco, head of U.S. equity strategy for Bank of America Merrill Lynch. Mark, it's good to have you on the show again. Can you tell us where are you today?
Well, I'm actually on the beach in Vietnam near Da Nang in Hoi An at the Nam Hai Hotel, which is a beautiful place.
That's one of the reasons we have you on,
Yes.
just so I can ask you that question. You're living in Hong Kong and sometimes Thailand now?
Yes, I have an office in Hong Kong. I lived there for 30 years and have a house in the north of Thailand in Chiang Mai, and also this house on the beach in Vietnam.
Awesome. Very, very good. Okay, so it's a great time to talk to you as we head into the new year. What are the biggest trends you see for 2010?
Well, I think that 2009 was an extraordinary year for capital gains because the markets, both commodities and equities, became extremely oversold at the beginning of the year, specifically in March 2009. And since then, the S&P is up close to 70%, and the Russian RTS index is up by 220%. I mean, these kind of gains you won't see in 2010. I think 2010 is a year where capital preservation will be more important because I expect quite a lot of volatility, both up and down. And essentially, we could, as in the case of gold recently, which has corrected 10%, we could easily see in equities at some point a 10-20% downward drift.
Okay, for equity, so volatility on the upside and on the downside. Go over some of the other markets then. What do you expect from gold? What do you expect from dollar? What do you expect for the credit market?
Well, I'm very sorry to say that this is one of the few times where I have no precise ideas how 2010 will end, because there are so many factors that will affect investment markets. Whether it's the dollar or whether it's an economic recovery or rising interest rates or geopolitical events, all these are tied into each other. And we could essentially end up the year without making much money. In other words, you will make money in some asset classes and maybe lose in others. In general, for gold, I don't think that we will have a huge rally in 2010, but I think that it's a very good insurance to have in terms of if something goes wrong in the world, that you have a currency that is an honest currency vis-a-vis paper currencies that can be manipulated by central banks and governments.
Mark, it's David Bianco. I'm curious to know, why is it that you think a stronger dollar will be positive for the equity market?
Well, I mean, if you look back at the last 10 years, 2002 to 2007, we have essentially strong asset markets and a weak dollar. Then 2008, we have a strong dollar and weak asset markets. And since the end of February 2009, the dollar was weak and asset markets rebounded very strongly. So everybody in the whole world believes a weak dollar leads to essentially strong asset markets, and the strong dollar is not particularly good for asset markets. Now, so much money has gone into emerging economies, and so much money is parked into bonds and cash still, that if the dollar were to strengthen, it could channel money out of other regions of the world into the U.S. And let's say the U.S. S&P and the Dow have grossly underperformed emerging economies, stock markets, since 2002. So, I mean, you could have some kind of a reversal where people would say, okay, the U.S. is not doing particularly well, but the rest of the world is maybe doing even worse. And don't forget, it's not necessarily my view, but some, let's say, reliable forecasters are thinking of an implosion in the Chinese economy in 2010. If that happened, then obviously money would move out of emerging economies into something safe. That would be, say, U.S. large market cap stocks.
Right, Mark, you talk about that very scenario being possible, and even though you're looking for some sort of correction in early 2010, you say U.S. could outperform emerging markets, equities would outperform bonds, all these money managers coming back home to U.S. equities. Are you actually calling for that to happen, or are you just saying it's one of many possibilities?
Well, my feeling is that the U.S. market will outperform emerging economies in the first 6 months of 2010. Beyond that, I don't know, but in the first 6 months, that is quite likely. Whether the outperformance comes because markets continue to move up, or the outperformance comes because the U.S. S&P goes down less than emerging stock markets, that is debatable. My scenario is either the markets, the S&P, which has traded essentially sidewards since October 21st. We're up 2% on the S&P since October 21st. It will break out on the upside here and maybe go up another 15%. And then you'll get a more meaningful correction of around 20%. Or we could correct here, say 10, 20%, and then have another run on the upside. That I'm not yet sure. That the next few days will be important to watch, whether the recent breakout move for the S&P on the upside is a genuine breakout move or a false breakout move, as happened in the euro just 2 weeks ago.
But you are saying that putting more fresh money into treasuries is perhaps the worst thing you could do.
From a longer-term perspective, for sure. But near-term, stocks are a bit overbought, and U.S. Treasury bonds are oversold, and most forecasters are very negative about Treasury bonds, which disturbs me a little bit. It was a year ago when the yield on Treasury notes, the 10 years, went down to 2.08% on December 18th. The bullish sentiment on bonds was very high. That was the perfect time to short U.S. government bonds. Now, the sentiment is rather negative about treasuries, and so I believe that we could have a rebound for, say, 1 to 3 months.
Yeah, so the extraordinary year that we had in the capital markets set us up to have these huge capital gains last year, or this year, Mark. It sounds like you're almost saying 2010 is kind of going to be a throwaway year where there will be a lot of movement and activity, but nothing as significant to key off of as what we saw last year. If you go out 2, 3, 4 years, will we be able to take care of this, to deleverage effectively, and to actually, will we see the stock markets around the world go up 50, 60, 100% over the next 3 or 4 years, or are we permanently disabled by what happened?
Well, I'm sorry to say, I don't see much deleveraging, because the private sector is indeed deleveraging, but the government is leveraging up. So total credit as a percent of the economy is still increasing in the United States. And I think this process will continue. And when it becomes apparent that the economy is not very strong, the Fed will monetize even more, and there will be larger fiscal deficits. And eventually we will have higher inflation rates, and this will be bad, obviously, for government bonds and cash, and relatively good for equities. So if you ask me 5 years from now or 10 years from now, I think equity prices will be higher than they are now, and the dollar will probably be significantly lower, and gold will be significantly higher as well, as it gains against paper currencies all over the world.
All right, Mark, before I let you go, you're on a beach at a luxury hotel in Vietnam. So what the rest of the week, what are you going to be doing? You're going to play golf? Do you hang out on the beach? Do you have a few cocktails? What's in the cards for you, just so we can sort of get a visualization of what's coming up?
How many women are surrounding you right now?
I was afraid to ask that. But.
Yeah, that's a very good question. I was in Rajasthan, which I recommend highly to you. It's like 1,001 nights It's fantastic. And then with my family, and then we came here to Vietnam, and we're not doing very much. Actually, I'm writing a report, so I haven't enjoyed the beach very much. And in the evening, we go out for dinner to local restaurants and sometimes at the hotel.
Very good.
But because I'm with the family, I'm not surrounded by concubines.
All right, with that, okay, then I've got to go back and just get a whole new recompute everything, because that's what I was saying. Anyway, Marc Faber, thank you very much, and we love to have you check in. It's like, where's Marc Faber? It's kind of our own little segment here on Squawk Box. Thank you.